Investing for income versus strictly investing for growth and total return is a growing trend. People are willing to give up some of that upside potential for some consistent income. And this is especially true as they move into retirement. They're looking for that replacement paycheck. They used to get one, they still want one, so they're utilizing some of these products. And there's a lot of them available these days. So I wanted to talk to someone that's been using the strategy successfully. And I found none other than Armchair Income. Maybe you've seen some of his videos. He's got lots of them out there, and sometimes we cross paths, but only in a good way. So I went out and I talked to him because he's been retired for 7 years and he's been deploying the strategy successfully. We talked about the do's and don'ts, the products he likes, what he doesn't like, and how he manages his portfolio, and so much more. So that's what we're going to talk about. If that is what you're looking for, please stick around. Boop. So one popular trend these days is investing for income, and we're talking about products that distribute money every single month or every single quarter. It's really popular for those also that are in retirement. So everybody that wants to replace that old paycheck with a new paycheck. So you've been retired now since 2017, and you're managing your own portfolio. Your focus has been on income investing to provide routine cash flow. Is that accurate?
Yes. When I was working prior to 2017, I didn't have much time for this. So I had a financial advisor and they were great. And then, of course, when I retired, I had to switch things around a little bit because when I was working, I was doing the same thing that you're doing, which is focusing more on growth because the goal was just to build the biggest nest egg that I possibly could and work hard, make money and save it. And then hopefully the egg's huge, right? But when I retired, I had to solve a different problem, which is how to pay the bills when you don't have a job anymore. So build the biggest nest egg, pay bills without having a job, two different problems. So I shifted from growth to income. But first I considered all the different options because there's lots of ways to approach this. So the 4% rule is one, which I think we'll talk about later, but that would mean selling some of your investments to pay the bills, which works sometimes better than other times, depending on the market. So I didn't really like that idea of selling my nest egg, so to speak, or part of it. Another way would be to keep some in treasuries or cash and then sell the growth stocks when the market's up, and then when it's down, maybe use the cash instead. So kind of timing it a little bit. I looked at dividend growth investing like SCHD or a basket of stocks like Johnson and Johnson and just get 3 or 4%. And then the income would just grow by itself because those grow pretty well. I was in real estate, so I could have held those and lived off the rental income once the debt was paid. So I looked at all these different things, but I ended up choosing income investing, which is basically focusing or optimizing for the income, which means higher yield, less growth. So let's call it 10 or 11% of yield blended across the portfolio, spending some of that, reinvesting some of it, because you've got to stay ahead of inflation, which we'll get to a bit later, I think. So that's the direction that I ended up taking, and so far, so good.
And that's one of the big differences, I would say, because we cross paths in many ways, but you are actually 7 years into retirement where I'm still kind of working towards that and deciding when I want to do that, what my approach would be. So what can you tell us about this approach to investing when we're just talking about investing for income?
So it's 2017, we're in 2024 now. So far, it's worked great. I'm very happy with it, which is one of the reasons I started this Armchair Income channel, because I love it and I can talk about it all day. And when I try to talk to my friends about it, some of them start glazing over, but I'm sure there are some people somewhere who would like to talk about this. So I decided to share the stuff that I'd learned just in case other people wanted to chat. And that's pretty much how it's worked out. So we've built a bit of a community around that. But when I was thinking about this strategy, one of the main things was to avoid stress. So for me, stress was two things. Would it pay enough money to pay the bills? Like, would I get enough money, even if the market crashed, right? And the other one was I didn't want my emotions to be tied to the market. So I don't know if you've got friends like this, but maybe you're playing golf or something and you say, how's it going? And they go, ooh, market's down a bit. Like in 2022, market's pretty rough. And you can see they're a bit stressed. Or you say, how's it going? And they say, yeah, market's hot. I got some NVIDIA, it's rocking. Like they're clearly happy because they see a lot of green on their MSNBC or their Bloomberg or whatever. And they're sad when the market's. I just didn't want any of that. So it just doesn't work for me psychologically. So the income investing has avoided those two stresses, not having enough money or being emotionally tied to the green or the red colors on the market. The only stress I've had so far in the 7 years was, I think, the same time everyone else was stressed, which was March of 2020 for obvious reasons. And I was worried that the dividends wouldn't hold up because I didn't know what was going to happen with the economy. I didn't know if the economy would crash, if businesses would go bankrupt, if the government would, well, the government was going to intervene. I didn't know if it was going to intervene enough to change the stock market, which ended up happening. So I sold a lot of stocks and funds out of fear. And that turned out to be a bad decision. So I don't want to sugarcoat it, but that wasn't the fault of dividend or income investing. That was just me being a wuss. And what actually happened was that the dividends held up, and it sucked for me because I had to, the hard part wasn't selling. When you're scared and you sell to cash, you feel fine, right? You feel safe. The crappy part was, when do I buy back in? Because remember, the market bounced up pretty quick, faster than everyone expected. It was like a V. And I didn't know if that was sustainable or whatever. So I was stressed about when to buy back in, not the actual selling. So if I had my time again, I just would have stuck with it and kept my dividend paying stocks and funds, and actually everything would have been fine.
Yeah, that you can see that stress going all the way back, the financial crisis. You talked about people that have put money on the sidelines and they've kept it there ever since, and they have not seen that growth you get by being in the market. So very interesting and a great point. So what does your general portfolio breakdown look like now that you've been through all this, you've reviewed all these products? So do you have all types of funds, or do you have some long-term traditional ETFs in there as well? Do you have mutual funds, individual stocks? What does it look like?
Well, I've got 37 stocks and funds, and I'm going to do a detailed breakdown of every single. No, I'm just kidding. 37 is more, I think, than most people need, but I have to admit I love this stuff, so I'm happy to monitor it and really get into researching it. So that works for me, but I think for most people, they would want less than 37, which is fine. The portfolio is optimized for income. And I would never tell anyone what they should do, but there's growth people, income people, and then there's hybrid people that mix the two. I think all of that is fine. I've chosen income exclusively, and it works for me. And the breakdown of the portfolio is, I'll give you a few categories. There's covered call index funds, which we've both talked a lot about on our channels. There are business development companies, and I've got a fund of business development companies as well. There are preferred shares, there's REITs, M-REITs, which are mortgage REITs. There are closed-end funds, and those are broken usually into themes. Like there are some that focus on utilities, some that focus on fixed income, some that focus on healthcare. I've got a midstream partnership that maybe we'll touch on later. And then there's SVOL, which shorts the VIX, which you can't really put into any category. That's kind of a unicorn or a unique one. So it's quite a mix of different risks, different yields. And when you mix it all together, it produces an income that I'm very happy with.
So what are some of your favorites in this area? If you had a couple extra $1,000 out there, what would you be putting into? You have a few favorites at this moment?
Give you some examples. Let's be specific then. Some tickers, right? Because if I'm watching these videos, I want tickers that I can look up and see if they're interesting to me, right? So let's kick off with one I think both of us probably like, which is JEPQ. So that's a covered call fund. It's paying 8.8% when I checked today, but it changes every month. So next month it could be 10. The month after that it could be 8 or 9, like who knows? But it's usually in that range. It's managed by JP Morgan, and it selects stocks from the tech-heavy NASDAQ 100, and it usually holds close to that, about give or take 100 stocks, and it sells covered calls against them, which is something you're obviously very familiar with. Next example, Ares Capital. This one is a BDC, business development company, and it pays 9.3% yield, which is quite hefty. Not a fund. This is an individual company that's a private lender. And there are about 50 business development companies. Of all of those, this one is by far the biggest. So that brings some benefits in terms of their access to low-cost credit and so on. And if you want to know how reliable their dividend is, you can look at a dividend chart that goes back 20 years and see they just had one cut, which was, not surprisingly, just after the global financial crisis. They cut from 42 to 35 cents, which I'm sure at the time would have sucked, but not totally disastrous. And since then, they've continuously grown their dividend, and now it's sitting at 48 cents. So that's a nice one. Next up, PFFA is a fund of preferred shares. So preferred shares are interesting for retirees because the income is more predictable than it is for regular shares. So this one has about 200 different preferred shares, which frankly is a lot of work to keep track of that many. But basically with regular stocks, the board decides how much to pay each quarter. And that could be anything, right? I mean, usually it's consistent, but they're not obligated to pay a certain amount. But with preferred shares, the distributions are set when it's issued. So you're not waiting for the board to make any decisions. If they issue it and say it's going to be 6% of $25, that's what it is. And it will remain at that level. Second to that is that if they have financial problems, the regular dividend is the first one to be cut, and the preferred, as the name implies, they're further up the capital stack. So if the company runs into some problems, you're a little bit safer if you're holding preferred as opposed to regular shares. And this is one that hasn't had a great run over the last few years because high interest rates are not good for them. They, in terms of their price, react similar to bonds, which is the opposite of interest rates. So when interest rates were going up, these went down in value. And so I'm assuming that going forward, one day, maybe interest rates will get cut and these will benefit. The other thing is this fund is leveraged. So there's a cost to that, an interest cost to that leverage. That interest expense will reduce when rates come down. So those will be tailwinds in the future if the Fed ever cuts rates. And then the last example I'm going to give you is SVOL. I think you're pretty familiar with this one. This one doesn't fit into any category. It's a standalone, but they short the VIX, and which is a measure of volatility, and it pays 16%. Now, the huge risk with this one is if the VIX has a massive spike, this one would be absolutely destroyed, but they do have calls on the VIX as a hedge against that. So they assure us that the hedge will cover it. We don't know, of course, for sure, but that's an interesting little seasoning to throw into the mix because of the 16% income that it's paying.
That is a very interesting product and one that I own as well. But I think, small doses is what I always talk to people about. Mixing a lot of these together can have good results. And that kind of brings me to, other products that you steer away from and why, because I know in this segment, there are some very expensive products. That is, there's some that have very high fees. So are there any products that you've found in this arena that you're just like, nope, I don't want to go there. I don't like these?
Based on fees, no. I'm open to high fees if the total return justifies it. And I'm just I'm not against paying someone to do a lot of work. So some of these funds just aren't much work. Like think about Global X's XYLD or QYLD. Like there's nothing to do, right? A computer can run those funds because they just follow a formula. Then you've got other funds like the one I mentioned, PFFA, that's leveraged and manages 200 preferred shares. if you've ever looked into preferred shares, they are incredibly complicated, which is why everyone doesn't own them. So I respect that they have a lot of work to do and they should get paid. Now, having said that, I'm glad you mentioned fees because so many people misunderstand the fees on BDC funds and preferred share funds because they do look high. So on PFFA, it comes in at over 2.5%, which looks crazy. But most of that is actually just interest expense. And the actual fee for the management is 0.8%, which is a bit high, but it's not insane. So let's put aside the fee discussion. And I'll just say, if the returns are good enough, I'll pay the managers because maybe they have a lot of work to do. Things that I do avoid, though, to answer your question, are just buying based on high yield. We both know there are funds that are paying like insane numbers, 50%, 60%, 40% yields, which sounds good, but the NAV just erodes like crazy in most cases. So avoid those. I avoid buying purely based on yield history. So sometimes you see the yield on a chart and it looks like for the last 10 or 20 years, they've paid the same amount. So surely it would be safe. No, I do look at what's happening now in the fund or the business and what's happening in the near future for the fund or the business and consider that, not just looking in the rearview mirror at history. So an example would be MPW. Do you know that REIT? So that one had a fantastic history. I think they had one cut after the global financial crisis of 2008, and that's it. It just grew steadily over time. A lot of people were invested in it. I subscribe to a bunch of different income-related newsletters, and one that I really trust said, avoid this one because one of their tenants was having too much, it was Stewart, was having too much effect over their future. They had them by the proverbials. And they weren't very transparent about what was happening with Stewart. So I got out of that particular REIT, despite the fact that its dividend history was absolutely, well, not absolutely fantastic. Their dividend history was very good because I wasn't comfortable with what was happening at the present and what was likely to happen in the future. And then there you go. They had a huge dividend cut in 2023. So a long history is not a guarantee of future payments. So those are the things that I avoid generally. I try to research as much as I can. And then, of course, the point of the channel is to share what I learn.
So with this strategy, investing for income, it's different than just stuffing money into an index ETF and trying to grow that over time, especially when you're a young person. I think that's the go-to strategy. So how do you, now 7 years into retirement, how do you balance income, growth, and the effects of inflation with these types of products? How do you manage that?
Yeah, that's become a really important thing, inflation, since 2020 for obvious reasons. So some of my investments grow by themselves. So an example would be HESM, which is the midstream company or midstream partnership. That's only paying 6.3% at the moment, which is a bit low for what I do. But they do grow their distributions like clockwork, which is great. So for that one, I don't really need to do any reinvestment of the income. It just grows all by itself, which has the flow-on effect of growing the share price as well. So that grows all by itself, but I don't invest anymore, if this is what you're asking, in like Apple, Nvidia, SPY, VOO, XLK. I'm not in hot growth tech funds or even market indexes anymore. Everything that I'm doing is income focused. So to answer the question about inflation, how do you deal with that? Because if it was flat, you'd be in trouble over the long term. Some of it is things like HESM where they grow by themselves. Another example would be STWD, which is Starwood Properties Trust. They're flat. They haven't raised their distribution since 2014. But it pays a whisker currently under 10%. It's 9.9, I think. So for that one, I wouldn't spend all of the income. I spend part of it, reinvest part of it, so that I'm consistently buying more shares, the income is constantly growing, not rapidly, but enough to stay ahead of inflation.
I guess something else, I like to manage my own option trades, but I do own some of these funds as well. I've reviewed some of these myself. When it comes to portfolio management, that takes time for me on a weekly basis. So that there seems to be a trade-off here, right? So you're actually in retirement. I'm not. I make this part of what I do. But there's definitely that trade-off of time versus the expense of owning the fund. So we kind of talked about the fees a little bit. It could be 0.25% up to maybe 1.5%, maybe even 2% for some of them. But you also have the added bonus of having the expertise. I always try to point out to people that anybody that builds an ETF, they're not doing it to think how they can get the money. They're doing it because they're proud of their product. They're trying to put it out there, and they know if the product is successful, that'll bring in the money. So cart before the horse kind of idea. So they are professionally managed. So there's that added advantage as well. So within your group of ETFs and products, do you do much trading, or do you have much time, I guess, in portfolio management? Or are you committed to these products and you stay invested?
I do spend a reasonable amount of time on this, but that's partly because you can't just set and forget these. You can't buy them on the 1st of January and then in the 31st of December look back and think, oh, I wonder what happened. You do need to pay attention. But for me, I love this stuff, so I would do it anyway. So I probably spend about an hour or more per day reading up on, researching income-related stuff. And that would be reading articles from Seeking Alpha. That would be reading newsletters that I subscribe to not only monitor what I have now, but also I'm always looking for new stuff as well. So that is, I wouldn't say it's a time commitment, but it's time that I definitely spend regularly. And the funny thing is, now that I have this channel, I feel more responsibility, which has been great for me. So when I was just by myself and not talking to anybody, I did the same thing. But now that I'm going to go public and talk about these funds or companies, I make sure every T is crossed. I double check every detail. And I wasn't doing that when it was just me, obviously. So that's actually been great for my portfolio, frankly, because I pay more attention to everything now. So yeah, there is a bit of time involved. When it comes to trading, though, not much. I would probably, if I had to average it out, it probably comes to one trade a week, 4 trades a month, something like that. I'm not a technical person. I don't follow the Bollinger Bands or the momentum or anything like that. I don't try and time things. I don't think that I know when something is going to happen and then trade around it. I don't expect I would ever sell at the top or buy at the bottom. So I'm just not a believer in being able to time the market. So my trades are more based around what I think is a good source of income, as opposed to what I think the price is going to do in the coming days, weeks, or even months.
I did see one of your videos talking about 8% versus 4%. And we also had Dave Ramsey come out recently and say that the 4% withdrawal rate was too conservative and an 8% withdrawal rate was perfectly fine. And I do believe the 4% rule is flexible, and it depends on what kind of return the market is giving you. And I don't think people are as formal as they like to think they are in retirement, saying, here's my 4%, I'll withdraw this, and next year I'm going to do this. People adjust to things. But you had a video about 8% versus 4%. So what are your thoughts behind increasing your withdrawal rate? Somebody that's been in retirement now for 7 years, and how do you manage your cash flow from these income producing funds?
So I'll start off by saying I disagree with, I'm not a Dave Ramsey fan. So if you need to get off credit cards or save money, whatever, he's great. But there was, like you said, a lot of reaction to his, and I think the motivation behind his comment was his returns are more than 8%, so he could spend 8%. There's a lot of luck involved if you withdraw too much. If you withdraw a lot when the market's firing on all cylinders, it doesn't matter, right? You'll be fine because the stock market returns are great. But if you do it at the wrong time during a bear market, it'll just crush your portfolio. And if you did it in after 2000, the bubble burst, or if you did it around 2008, what he said. You'd be in deep trouble. So I disagree with him on that. And fundamentally, the 4% rule is about selling some of your portfolio and staying within the bounds of its long-term returns. The 8% rule that I made the video about is not that at all. It's not selling 8% per year. That's a dumb idea. No, it's about not selling anything and just living off income instead. And if the income is greater than 8% and you withdraw 8% and reinvest the rest, then the income will grow. The only thing that you have to watch out for is you need to pick stocks and funds that don't cut their dividends or collapse, obviously. If you can do that, then yeah, you can just live off the income that comes from them. But it also requires, I think, quite a lot of diversification to spread out your risk. So for those reasons, I didn't subscribe to the 4% rule. I kind of came up with my own rules and decided to go down the income path. And that's what works for me. And as we discussed earlier, reinvesting some of it because of inflation. And then as for the cash flow part that you're asking about, so each month, when I last looked, my portfolio was generating whisker under 11%, right? So in round numbers, that means I'm spending about 8% of that and reinvesting the other 3% so that the income grows. So once a month, I'm pulling some cash out of my brokerages, using that to pay bills. And then each month I'm looking at what I think are the best opportunities at that time. So I don't do drip, dividend reinvestment plan. Don't do that. I want to buy whatever I think is the best opportunity at that time. And that's about once a month. So that's how I manage my cash flow. And then I don't have any debt. I don't have any mortgages, leases, car loans, nothing like that. And I have a relatively low cost of living. And my biggest expense is international travel. But obviously, if there was some kind of disaster, I could cut back international travel because that's a variable cost.
Yeah, that's, I'm chugging coffee and I got up early to talk to you because you're halfway around the world. So that leads me into, and this is a complicated question because we do live in different parts of the world, but you did live in the United States for quite a while, right? But how about tax considerations with distributions? Because this obviously in the United States here, a lot of these income funds, if it's not in a tax deferred account, there's lots of tax liability. So you have to be intelligent about how you approach that. So how about tax considerations with distributions?
Yeah, I brought the tax code, so we're going to go through it. No, I'm kidding. So growth investing is more tax efficient than income investing. That's a negative of what I do is there's more tax. So I wouldn't advise someone who's a long way from retirement to go heavy into income investing because tax-wise, it's not going to be good. But when you are retired, of course, you don't have the paycheck anymore. So that lowers your that income problem. Now, some funds are more tax efficient than others. So I think you might have mentioned an example, but it would be SBYI and QQQI. They pay most of their distribution as return of capital as a tax treatment, which means that you're not taxed on that portion, which is most of the actual distribution, until you sell, if you sell, the fund. And then when that happens, the rate that you would pay would be calculated on short or long-term capital gains, which is usually less than the rate you would pay on your income, depending on your tax bracket. So that's a plus. But I'd say the majority of the investments I have are paying out ordinary income, which is not as tax efficient as the two examples that I just gave. So, tax is, like you said, very complicated subject. And if you're in or out of the US, that makes a huge difference to everything as well. So that's one of the main reasons why what I do is probably something to transition into either close to or when you actually retire.
For somebody that has so much experience that has actually done this for 7 years versus me that are looking at it, considering it. I did a video recently about what I think I might do in retirement versus what somebody is actually doing and having success with. I think is great. So for those that are more, for those that are interested in this topic, want to find out a little bit more about your channel, Armchair Income, what's a video that they could run out right now and watch to maybe get a little bit more information about this topic?
My channel talks about all the things we discussed today, but I don't preach that I think I have the best investment strategy, but I think some people might just mix it in with whatever they're currently doing. If you love growth, you could maybe, or let's say your portfolio is generating 4% and you want to figure out a way to get it to 5%. Maybe some of the things I talk about could get you up that little bit extra. As far as a video, I did one in April that was a breakdown of my top 10 largest investments. And I've got a playlist that actually goes through all my portfolio one by one, but it starts with that video, which are the 10 largest. So if I had to point to one, that would be the video to watch to get a sense of what I do and the thinking behind it.
Definitely link that down below and people can run out and get a sense of what you're doing and how they could maybe incorporate part of this. Because I love the idea of growth and income. So I'm in the middle a little bit there. But yeah, I really appreciate your time today, coming out here and talking to me, staying up late to talk to me here from around the other side of the world. So thank you so much.
My pleasure. Thanks, Dave.
Always great to hear about a subject from someone who is actually doing it. And if you want to find out more, the information for his channel is down in the description. So go check it out. Also, if you like this type of content, please like and subscribe. If you have any questions about what we talked about, ask down below. And have a great night. Really appreciate you watching. Take care.